Most people think trusts are for the ultra-wealthy, for the people with private jets and family offices and teams of attorneys on retainer. But that's not actually true, and understanding how these structures work could be one of the most valuable things anyone with growing assets ever does. Today, a breakdown of the most important types of irrevocable trust, what each one solves, and why the right one depends entirely on the problem being addressed. But first, one concept that makes everything else make sense. The big idea: control versus structure. A revocable trust is flexible. It can be changed, amended, or dissolved at any time. Assets stay in the estate. It's useful, but it offers limited protection and limited tax benefit. An irrevocable trust works differently. Once assets go in, direct control is given up. That sounds like a drawback, but that surrender of control is exactly what creates the benefit. Because what's no longer owned or controlled is generally no longer counted in the taxable estate, no longer reachable by certain creditors, and no longer subject to the same estate tax exposure. The rigidity isn't a flaw, the rigidity is the point. And right now, this conversation matters more than ever. In 2026, the federal estate tax exemption is $15 million per individual and $30 million per married couple. That's a significant threshold, but for families with appreciating real estate, retirement accounts, and business interests, it's closer than most people realize. And the top federal estate tax rate above that threshold is 40%. Here's a look at the most commonly used irrevocable trust structures. First up, the SLAT, Spousal Lifetime Access Trust. This is one of the most popular tools for married couples who want to move assets out of the taxable estate without completely losing access to them. Here's how it works. One spouse funds an irrevocable trust for the benefit of the other spouse and children. The donor spouse gives up direct ownership. But because the beneficiary spouse can access the trust, the household still has indirect economic access, removing assets from the taxable estate. The key risk: if the beneficiary spouse dies prematurely, the surviving spouse loses access to those assets entirely. This is why the structure needs careful thought. Some couples set up two slats, one for each spouse, with materially different terms to avoid what's known as the reciprocal trust doctrine. Next is the ILIT, Irrevocable Life Insurance Trust. This one solves a specific and often overlooked problem. Life insurance proceeds can be surprisingly large, and if the policy is owned personally, those proceeds are included in the taxable estate. An ILIT removes that exposure. The trust owns the policy, not the individual. The death benefit is paid to the trust free of estate tax. The trust is funded each year using the annual gift tax exclusion, currently $19,000 per beneficiary in 2026, to cover premium payments. One important rule: if an existing policy is transferred into an ILIT, it must remain there for at least 3 years before death for the proceeds to be excluded. Now, the Dynasty Trust. This is long-term planning at scale, designed to avoid the generational estate tax reset. Instead of passing wealth to children who pay estate taxes and their children paying again, a dynasty trust keeps assets compounding inside the trust. Depending on the state where the trust is established, it can last for decades, or in some states, indefinitely. Wealth organized across generations. Next, the GRAT, Grantor Retained Annuity Trust, a powerful strategy for assets expected to appreciate significantly. Appreciating assets, a growing business, publicly traded stock, real estate, are placed into the trust for a set term, typically 2 to 5 years. The grantor receives fixed annuity payments back. After the term ends, any growth above a government-set interest rate passes to heirs with minimal gift tax. One critical risk: if the grantor dies during the GRAT term, the assets are pulled back into the taxable estate. Shorter GRATs reduce this risk. This one applies specifically to real estate, the QPRT, or Qualified Personal Residence Trust, typically for a primary home or vacation property. The homeowner transfers the residence into a trust for a set term, say 10 years, while retaining the right to live there during that period. The value is often reduced for gift tax purposes. Beneficiaries only pay taxes on the value at the time the trust was established, not the appreciated value. The risk: if the grantor dies before the term ends, the home reverts to the taxable estate. It's a balance that has to be modeled carefully. Now, a very important one, the Special Needs Trust. This is about protecting a specific person and their eligibility for government benefits. Direct inheritance can inadvertently disqualify them from assistance like Medicaid or SSI, which have strict asset thresholds. This structure prevents that. The trust supplements, rather than replaces, government benefits. For families with a disabled child or dependent, this isn't optional, it's essential. Then there's the spendthrift trust. This one protects against behavior and outside claims from creditors or divorcing spouses. Instead of a beneficiary receiving a lump sum, the trust controls how and when distributions are made. The trustee manages the assets. Creditors and divorcing spouses generally cannot reach assets still held inside the trust. Only distributions already made are exposed. Finally, DAPT and MAPT. A domestic asset protection trust offers a layer of creditor protection in favorable states. Jurisdiction matters enormously. A Medicaid asset protection trust is focused on long-term care. Assets are transferred early before a need arises. Planning 5 to 10 years in advance is standard. Each of these trusts solves a different problem. SLAT for access, ILAT for insurance, Dynasty for legacy, GRAT and QPRT for efficient transfers. None of these are plug and play. Everyone requires an experienced estate planning attorney and coordination with financial and tax advisors. Wealth isn't just what gets earned, it's how what's kept gets organized. An irrevocable trust is about assigning purpose to your assets. One for protection, one for legacy. Estate planning stops being something to put off and becomes a deliberate financial decision. Talk to an attorney. The structures exist. The question is whether they're being used.